Once again, the Federal Reserve cut interest rates, and once again, mortgage rates didn't cooperate. By the end of Friday, mortgage rates had climbed back near the highest levels of the week, closing out another stretch where borrowers saw no real benefit from a Fed move. This keeps reinforcing one of the biggest misconceptions in housing finance. Fed rate cuts do not automatically lead to lower mortgage rates. Here's the simple truth. The Fed funds rate applies to extremely short-term loans, often overnight borrowing between banks. Mortgage rates, on the other hand, are long-term loans that stretch out over 30 years. Because of that, they respond to completely different forces. Inflation expectations, economic growth, and investor demand matter far more to mortgage rates than the Fed's overnight target. Timing makes the disconnect even stronger. The Fed meets only 8 times a year, but mortgage rates move every single day. Markets almost always know what the Fed will do well in advance, so rates often adjust before the announcement ever happens. In fact, every Fed rate cut in 2025 was priced in with more than a 90% probability ahead of time. This week was no exception, which is why rates barely reacted. Another reason mortgage rates stayed put is that markets now see very few cuts ahead. Expectations have narrowed significantly. Investors are pricing in just one more rate cut by early 2026, a view that's been solidifying for months. As expectations tighten, so does rate movement, keeping both Treasury yields and mortgage rates stuck in a narrow range. At this point, Fed decisions themselves matter less. What matters now are things markets can't predict in advance, like upcoming inflation and labor data. The November jobs report and the consumer price index will be far more influential. If both point toward economic cooling, rates could fall. If inflation runs hot, it could cancel out any labor weakness. There's also confusion around the Fed's bond purchase plans. This is not quantitative easing. The Fed isn't trying to push mortgage rates lower, it's simply preventing liquidity from tightening too much. That move was expected and already priced in. The takeaway for borrowers is clear. Don't rely on Fed cuts to lower mortgage rates. Rates will move based on inflation, jobs, and market sentiment, not headlines. The smartest approach is still focusing on personal timing, affordability, and long-term plans, not predictions no one can make with certainty. For direct financing consultations or mortgage options for you, visit Nadlin Capital Group.